Welcome to the Deal Room. Today we're breaking down a net leased franchise investment in Florida. And even though it's only the real estate that's being offered for sale, we're going to analyze both the real estate and the business. Because when you buy commercial real estate, the performance of the tenant's business matters. Most investors focus on the location, the lease terms, and the cap rate, but that's only part of the picture. I go beyond that so you can assess not just the potential upside, but also the risks, both obvious and less visible, including the things you won't see in the marketing materials or the offering memorandum. So let's get started. Today's deal is an Arby's in Riverview, Florida, just outside of Tampa. The asking price is $1.9 million at a 5.1 cap, which translates to $96,000 per year in rental income. It's an absolute triple net lease, meaning the tenant is responsible for taxes, insurance, and maintenance. So from a landlord's perspective, this is about as passive as it gets. That said, the cap rate immediately tells you how this deal is being positioned. This is not a yield play. It's a safety play. You're being asked to accept a lower return in exchange for stability, predictability, and minimal involvement. For many investors, that trade-off is appealing, but it's important to understand exactly what you're getting in return. Starting with the location, which in real estate we know is always the first rule. The Tampa market itself is a positive factor. It's experienced strong population growth, inbound migration, and economic expansion, all of which support long-term demand. These types of macro tailwinds matter when underwriting restaurant real estate. The simplicity of the deal is also part of the appeal. This is a true passive structure with no landlord responsibilities, which for the right investor is a key benefit. But the real question is, what actually needs to go right for this investment to perform over the long term? And that starts with how the deal is structured. Looking at the structure, this is a ground lease, which is typically viewed as a stronger position for the landlord because the tenant has more capital invested in the site. So therefore is generally less likely to walk away. There are approximately 14 years remaining on the lease with 1% annual increases and multiple 5-year renewal options. So structurally, this is clean, predictable, and aligned with what most passive investors are looking for. The tenant is AES Restaurant Group, a large, established, multi-unit operator with a substantial footprint and extensive experience operating Arby's locations. So this is not a small or inexperienced franchisee, which adds a level of comfort from both a credit and operational perspective. From a real estate standpoint, the location also appears strong, supported by traffic patterns and surrounding retail activity. According to the offering memorandum, the property has traffic count of approximately 40,000 cars per day and sits right on US Highway 301. The surrounding retail includes operators like Chick-fil-A, Lowe's, Waffle House, and McDonald's, which helps validate the strength of the trade area. So what I like to do as part of my due diligence is I like to go and virtually visit the site on Google Maps and drive around the area and just see for myself what's there. So here we are on Google Maps and I'm right here in front of the Arby's. And as we tour around, we can go up and down the street and really turn the corner, take a look at the building. There it is. I can see right here in the distance is the Waffle House that was mentioned in the offering memorandum. So it's right there next door, not a competitor, complementary to Arby's. There's McDonald's on the right. Again, Arby's does sell hamburgers, but McDonald's does not sell the roast beef sandwich. So there is that differentiator. We see the 7-Eleven and gas station. So you get the picture. I really like to drive around the area virtually just as a preliminary part of due diligence to get a feel for the area and not just rely on the offering memorandum and what it's telling me. So as you can see, while there is some overlap in the category, the corridor isn't oversaturated with identical concepts. So Arby's is still able to maintain a differentiated position within the quick service landscape. It's also worth noting this is newer construction built in 2019, and it includes a drive-through. And in today's restaurant environment, that's essential because drive-through, takeout, and mobile ordering are now core drivers of revenue. And any asset without that infrastructure is at a disadvantage. On the other hand, it also has a large dine-in component. And post-COVID, consumer behavior has shifted with fewer people choosing to dine in. So if I were evaluating this opportunity, I would want to review the sales history and really understand what percentage of revenue is coming from dine-in versus drive-through and off-premises channels such as DoorDash and Grubhub, because that mix really directly impacts what we call in real estate functional obsolescence, or how well the building will continue to perform over time. And this is where it gets interesting. This location was built in 2019, right before COVID, which means it was likely underwritten under a very different set of assumptions than what ultimately played out. During COVID, the restaurant industry didn't just take a financial hit due to the shutdown, it also went through a major shift in both cost structure and consumer behavior. And not every location fully recovered. So that context matters. And this brings up a critical distinction between the real estate value and business value. In real estate, new construction can enhance value. But when you're evaluating a business, value is driven by cash flow. And when you're buying a triple net at a low cap rate, you're not just buying a lease, you're making a bet on the continued unit level performance, brand relevance, and tenant renewal over time in order to sustain that passive income. So really, you're relying on the business to continue generating enough cash flow to support rent and on the tenant to keep operating at this location. So one of the key things I would want to understand here is the terms of the franchise agreement, because it's typically structured to be coterminous with the lease. That alignment matters because it gives you insight into the tenant's long-term commitment and the overall stability of the operation. If the economics make sense, the tenant stays and renews both the franchise agreement and the lease, and the investment continues to perform as expected. But if they don't, that's where risk can show up. The next thing I like to look at and to evaluate is the rent to sale ratio. Looking at the numbers, the rent appears reasonably relative to the estimated sales. I've evaluated a number of Arby's businesses, and their average unit volume is right around 1.3 million, which would put this location at roughly a 7 to 8% rent to sale ratio, and that's generally considered healthy and suggests the rent is supportable under normal conditions. That said, I would still want to review the last 3 years of profit and loss statements to really understand trends in both sales and profitability. That's part of my due diligence process when working with buyers to evaluate an investment property. Typically, that involves signing an NDA since this information is confidential. So it's not something I can share here, but as a buyer, I would absolutely want that level of transparency. And I will say not every operator is willing to provide it. So that's something you have to factor into your risk assessment. But even with that next level of insight, the next layer I want to evaluate is the brand itself. Arby's is an established and recognizable legacy brand, but it's not a high growth concept. The brand has experienced periods of flat or declining sales. They've had a decent amount of store closures, and there's ongoing pressure to remain relevant to a younger customer base. So for this investment to work long term, several things need to go right at the same time. First, the brand needs to stabilize and ideally grow same-store sales. It doesn't need explosive growth, but it does need consistency. If average unit volume flattens or declines, rent coverage tightens and the operator margins compress. Second, the brand needs to evolve without alienating its existing customer base, and that's a difficult balance. Things like menu innovation, digital ordering, and brand positioning all matter, but they ultimately have to translate into sustained sales volume. So when you step back and look at it this way, you realize this is not a risk-free passive investment just because it's triple net. The durability of the income depends on brand relevance, operator execution, and real estate fundamentals, all holding up over time. So this leads to a key question. If you're an investor looking to buy and hold, will this brand be more relevant or less relevant over the next 10 to 20 years. If it's growing, there's room for error. If it's flat or declining, the risk profile increases. At a 5.1 cap, you're paying a premium price, so your exit becomes especially important. If cap rate expands even modestly, that can materially impact the value. This is where a lot of investors get it wrong. Passive does not mean risk-free. It means the risk has shifted from active management to tenant performance, brand strength, and exit conditions. If the tenant vacates, the situation changes quickly. Now you're dealing with vacancy, leasing costs, and potentially significant capital expenditures. Even with a drive-through, a replacement tenant is not likely to be plug and play. The more specialized the building, the more limited your pool of replacement tenants. So while retenanting is often presented as a simple fallback, in reality, it can be complex, time-consuming, and expensive. Now for the $1 million question, or maybe the $1.9 million question. Is this a good deal? The answer is, it depends on the buyer and their goals. At a 5.1 cap, this is not a deal for someone seeking yield, upside, or much margin for error. It's a deal for someone prioritizing passive income, a newer asset, and a clean lease structure, and who is comfortable with the brand and tenant risk underneath it. There are real strengths here: a growing market, newer construction, a solid operator, and a passive lease structure. But at this pricing, you're paying for stability and not getting a discount for risk. Personally, I would want either a stronger brand at a 5.1 cap or a higher return to compensate for the uncertainty. That's what makes this deal investable for some buyers, but not compelling for every buyer. What are your thoughts? Would you be comfortable owning this at a 5.1 cap given the brand and tenant risk? I'd be interested to hear how you're thinking about it. Feel free to share your perspective in the comments below. I love to read everyone's comments and to understand your perspective. I hope this video was helpful and gave you a better understanding of how to assess an investment property. And if you're thinking about buying a franchise business or a triple net real estate asset and you want help identifying the right opportunity for your goals and getting a deeper assessment of the deal, let's connect. I work with buyers and sellers across the country as both a commercial real estate agent and a business broker. Until next time, I'm Mercedes Schaffer. This is the Franchise Deal Room, and I'll see you in the next deal.